Ladies and gentlemen, Asian Guy here, and I'm going to answer the question everyone's asking. Is silver a good or bad investment in 2026? But I'm not going to give you the typical one-sided answer you hear everywhere else. I'm going to examine both sides with brutal honesty, because your financial future depends on understanding the complete picture, not just the hype. Let me start with something most silver content creators won't tell you. Silver can be a terrible investment. And if you don't understand why, you could lose a lot of money even if silver goes to $200 per ounce. Here's the reality check you need to hear. Silver is one of the most volatile major assets in existence. It can drop 30% in a single day, stay flat for decades, and drive you insane with psychological torture that makes cryptocurrency look stable. If you can't handle watching your investment lose half its value overnight and potentially stay there for years, silver is not for you. But here's the other side. Silver might be the most undervalued strategic asset on Earth right now. And understanding why requires looking beyond price charts to the fundamental changes happening in our monetary system, our economy, and our technology. Let me break down the bear case first, because if these arguments don't concern you, you're not thinking clearly. The strongest argument against silver is its historical performance compared to other investments. From 1980 to 2020, silver was essentially dead money. If you bought silver at $50 in 1980, you waited 41 years just to break even. During that same period, the S&P 500 returned over 2,000%. That's not an investment. That's a 40-year mistake. Silver's volatility makes it unsuitable for most people's investment psychology. The metal can gain 50% in a month, then lose 60% in a week. Most investors panic sell at exactly the wrong time, turning what should be profitable long-term positions into devastating losses. The storage and insurance costs eat into returns. Physical silver requires secure storage, insurance, and often dealer spreads of 5 to 15%, both buying and selling. Those costs compound over time, meaning silver needs to rise significantly just for you to break even. Industrial demand can disappear faster than investment demand appears. If technology shifts away from silver-intensive applications, or if substitutes become economically viable, industrial demand could collapse. Solar panels could use different materials. Electronics could find alternatives. Investment demand alone might not support current prices. Government intervention remains a constant threat. In 1933, the U.S. government confiscated gold. They could do the same with silver. Emergency powers, wealth taxes, or strategic resource controls could make private silver ownership illegal or economically impractical. The paper market manipulation could continue indefinitely. If banks and governments can suppress silver prices through futures markets, ETF creation, and fractional reserve silver banking, physical scarcity might never translate into higher prices. Now let me explain why those bear case arguments might be completely wrong in 2026's context. The monetary system is breaking down in ways that haven't happened since the 1970s. We have record government debt levels, currency debasement accelerating globally, and central banks buying gold at unprecedented rates while printing money to fund spending they can't afford through taxation. Silver's dual role as both monetary metal and industrial commodity creates demand dynamics that didn't exist in 1980. The technology revolution requires silver in ways that are difficult to substitute. Every electric vehicle needs 2 to 3 ounces. Every solar panel needs approximately 20 grams. Every smartphone, every data center, every piece of modern infrastructure depends on silver's unique properties. The supply situation is fundamentally different than in previous decades. Silver has been in supply deficit for 5 consecutive years, meaning global consumption exceeds mining production. Those deficits are filled by drawing down above-ground inventories that took decades to accumulate. Mining production faces geological constraints that can't be solved by higher prices in the short term. It takes 5 to 10 years to develop new silver mines. Most silver comes as byproduct of copper, lead, and zinc mining, so silver production depends on demand for base metals, not silver prices. The geopolitical landscape creates silver demand from unexpected sources. Countries reducing dollar dependence need alternative stores of value. Trade settlement outside the dollar system requires assets both parties trust. Silver's portability and universal recognition make it valuable for international commerce. The paper versus physical divergence is becoming more pronounced. While paper silver can be manipulated through futures contracts and ETF creation, physical silver faces real-world constraints. When Shanghai Silver trades at premiums to COMEX silver, it signals that manipulation is losing effectiveness. Central bank behavior provides crucial confirmation of precious metals value. When institutions that create fiat currency are aggressively buying gold and silver, they're essentially admitting their own currencies are unreliable stores of value. But here's the critical part most people miss. Whether silver is a good investment in 2026 depends entirely on your investment goals, timeline, and risk tolerance. If you're looking for steady, predictable returns with low volatility, silver is a terrible choice. Buy index funds, treasury bonds, or dividend stocks instead. Silver is for people who understand they're making a specific bet about monetary system changes and industrial supply constraints. If you're investing money you need in the next 2 to 3 years, don't buy silver. The volatility could force you to sell at exactly the wrong time. Silver is a long-term strategic holding, not a short-term trading vehicle. If you can't handle watching your investment lose 30 to 50% of its value and potentially stay there for months or years, don't buy silver. The psychological stress will cause you to make emotional decisions that destroy returns. But if you understand that silver is essentially insurance against monetary system breakdown, combined with leverage on the technology revolution, it might be one of the best asymmetric risk-reward investments available. Here's how to think about silver's risk-reward profile in 2026. The downside is probably limited to 50 to 70% from current levels in a worst-case scenario. But the upside could be 300 to 500% if industrial demand combines with monetary crisis to create a perfect storm. Those aren't gambling odds, they're insurance premium calculations. You're paying current prices for protection against currency debasement and exposure to industrial revolution, while accepting the risk that neither scenario develops as expected. The position sizing becomes critical. Silver should never be more than 5 to 10% of most people's investment portfolio. It's a speculation on specific scenarios, not a core holding like stocks or bonds. The form of silver ownership matters enormously. Physical silver gives you actual ownership, but comes with storage costs and liquidity challenges. ETFs like SLV give you price exposure but counterparty risk. Mining stocks give you leverage but company-specific risks. The timing considerations are complex but important. Dollar cost averaging into silver positions over 6 to 12 months reduces the risk of buying at temporary peaks, but major geopolitical or monetary events could create opportunities for larger positions at advantageous prices. The tax implications vary by jurisdiction and holding method. Physical silver often receives different tax treatment than securities. Mining stock dividends face different rates than capital gains. Understanding your local tax situation is crucial for after-tax returns. The exit strategy planning is something most silver investors ignore until too late. Will you sell gradually as prices rise? Hold until specific price targets? Use silver as collateral for loans? Having a plan prevents emotional decision-making during volatile periods. The integration with other investments affects silver's role in your portfolio. Silver often moves inversely to stocks and bonds during crisis periods, providing diversification benefits. But it can also correlate with other commodities during inflationary periods. Here's my personal take, which you should verify through your own research. Silver in 2026 represents asymmetric opportunity for people who understand they're making a specific bet about monetary and industrial trends. The bear case assumes that paper market manipulation continues working, that industrial demand doesn't accelerate, and that monetary authorities successfully manage debt levels without significant currency debasement. Those assumptions might be correct. The bull case assumes that physical shortage combines with industrial acceleration and monetary crisis to overwhelm paper market manipulation. Supply deficits continue. Technology demand grows. Currency confidence declines. Those assumptions might also be correct. The investment decision comes down to which scenario you think is more likely, and how much you're willing to risk on that assessment. But here's what I can say with confidence. If you're buying silver as a get-rich-quick scheme, you're going to be disappointed. If you're buying it as insurance against monetary system changes while gaining exposure to industrial revolution, you might be making one of the smartest asymmetric bets available. The key is understanding that silver isn't really an investment in the traditional sense. It's a hedge against specific systemic risks combined with leverage on specific technological trends. Whether that hedge pays off depends on events largely outside your control. What is within your control is position sizing, timeline management, and emotional preparation for extreme volatility. If you can handle those aspects, silver might deserve a small position in a diversified portfolio. If you can't handle those aspects, there are much better ways to build wealth through conventional investments that don't require you to predict monetary system changes or industrial supply dynamics. This is Asian Guy, and whether silver is good or bad investment in 2026 isn't a simple yes or no question. It's a complex analysis of risk tolerance, investment timeline, portfolio construction, and scenario planning that requires honest self-assessment about your own psychological and financial situation. The people making the most money in silver are those who treat it as long-term strategic positioning rather than short-term speculation. But the people losing the most money are those who treat it as guaranteed wealth without understanding the very real risks involved. Make your decision based on education, not emotion, and never invest more than you can afford to lose completely.